Welcome back to Market Call. We want to jump right into Christine Poole's top picks and take a look at that. Microsoft makes it up first. Christine, why is Microsoft a big pick for you?
Yeah, so we have owned this name for a number of years, but the stocks pulled back about 6% when they reported their quarter at the end of January. So we think this is an attractive entry point. I think the reasons for the pullback, their cloud computing business, Azure, grew 31% year over year constant currency, but the market was expecting something closer to 32 or plus. The prior quarter, they had grown 34%, so a deceleration in the growth rate, which market didn't like. As well, they increased their spending, capital spending, to build out their data centers by quite a bit, more than, well, it's going to be about 85 billion, so up about 50% from the prior year, which was up quite a bit from the prior year. So I think investors are questioning, what's the payback on all this spending you're doing when your cloud computing business is not growing at a faster rate sequentially. Microsoft management maintains that they're more supply constraint. And so they feel that, towards the back half of this year, it'll be more in balance. So hopefully growth will pick up. But nonetheless, I think 31% is still a pretty decent growth rate. They're guiding to a growth rate kind of in that range for the balance of the year. And, their businesses, it's embedded in our daily lives. We have, Outlook, their office products, Excel, Word. They bought LinkedIn back in 2016, and now it's the largest professional network, online network around the world. Probably everyone uses it to look for jobs, build relationships. So they tend to invest in advance of something becoming mainstream. And then we know they started investing in OpenAI back in 2019, and now everything's all about artificial intelligence. So we think they're well positioned to ride the growth of this new trend. They are embedding AI into their products already. They have a recurring revenue stream, strong balance sheet, so good entry point given the pullback.
All right, let's go to S&P Global, which is your next top pick, and tell me why you're choosing S&P.
Yeah, so it's an information services provider, and all their operating divisions, very high margin. They target a 50% operating margin, so very profitable. A lot of it is subscription-based, so it's a recurring revenue stream, so less lumpiness in their results. So their ratings business is an oligopoly. They compete against Moody's in that, and once again, there's two sides of that business: transactional, which is when there's new debt issuance, they get compensated to rate the debt, and non-transactional, which is debt outstanding, and they have to review it on a continual basis. They've seen a large pickup on the transactional side, given the increase in capital markets activity. Their other divisions are also experiencing good growth. Very innovative company. They have what they call a vitality index that measures the percentage of new products in their revenue stream. They target 10% of their revenues coming from new products. They're at about 11% right now. So highly scalable, profitable business, well positioned, I think, to benefit from increased capital markets activity. They also have an indices business, which is the S&P. They do benchmarks for all the asset classes, and they get asset-linked fees based on ETFs that use their name. So we like it here. And, if you look at it, long-term compounder of earnings, and the share price usually does very well long-term as well.
Trading today at about 533 is what we looked at just now. Okay, let's go to Enbridge, which is your third top pick, which is quite a standard. People really like Enbridge.
Yeah, so, I always try to pick a kind of an income stock as one of my top picks. We talked about the pipelines earlier. So we like Enbridge. The yield is like 6.2%. It operates the largest liquids pipeline around the world, transport 30% of the crude oil produced in North America. They have a natural gas pipeline that transport 20% of the natural gas that is consumed in the U.S. So a very North American-focused company. Last year, they bought 3 utilities from Dominion Energy. Okay. So that increases their exposure to natural gas utilities, which is very regulated, very defensible cash flow streams. Companies increased their dividend for 30 consecutive years, increased it 3% last December. We expect that over the foreseeable future, they will continue to increase their dividend. Very solid backlog of growth projects. So it's pulled back a little bit, and we'll be buying here.
All right, sounds good. Thank you for those top picks. Yes. Hope you were watching and writing those down at home. And Christine, thanks for coming in. Appreciate it. Yes, we'll see you again soon, I'm sure. And thanks for watching us here on Market Call. We'll see you again next time. Stay tuned.